Today we're just going to continue with the intermediate session. So we're going to kick off where we left off last week. Yeah, I think the last session was last week, Thursday. And we're just starting strategy one. A lot of guys ask about strategy one. And that's because I think it's probably the most simplest one as well, aside from the bonus strategy. Because I think the bonus strategy is very straightforward. You just use the template and just throw everything on there, just give you all the signals, whether to buy or whether to sell. So I think that's even simpler. But for me, this makes a whole lot more sense. You get to learn the markets, but it's very straightforward, very simple. Nothing really complicated about it. Nothing so like black or gray rather. Everything is so like black and white. So it's either this or it's that. So we'll just go ahead and kick off where we left off from last week. So we're discussing strategy one, right? So strategy one is basically called the 5-star trading strategy. In that you like to have 5 different elements coming together in order for you to have like a real high probability trade setup. You can have one with very low probability, but anything less than 3 or less essentially. So anything with 3 or less stars, for me, I wouldn't consider trading at all. So it'll make sense what the stars are and obviously how to be able to look at them. I think once we get into more of the technical side and so like the practical side rather, because I believe that's really where you get to learn how to do things as opposed to obviously just consuming information. Right, now essentially we're going to be using 4 elements, right? So I'm going to be using 4 elements, so like at the basis of our analysis. First being round number, second being candlesticks, third being the moving averages, and lastly we'll be using Fibonacci retracement. Right. Now, those tools will help us to judge if a trade is good or not. Okay, because that's all we're doing, right? So we're trying to find good trades. I'm not trying to predict where the market is going to go. I'm just trying to follow our game plan and make sure that we follow it on a consistent basis. No if, ands, or buts when it comes to it. We get a trade position that's, or trade idea that's very high probability, meaning there's a higher probability of it working out, then we take that trade, right? So round numbers are essentially the number sequence, so usually used in the institutional community. It's used as take profit levels, stop losses, entries. It's sort of like looking at the South African rand versus the United States dollar. So it's trading at 14 rand. If the dollar costs you 14 rand to purchase $1, then that's a round number essentially. So I like to use a USD ZAR example because I think a lot more of us are familiar with it. I know some guys aren't from South Africa, so hopefully you guys can bear with me on that one. But what I'm saying is, if you're looking at this, let's just start with 13, right? So for $1, it costs you 13 South African rand. So this is how it would be, so like illustrated on the MT4 platform. So this 13, and it moves up to 1301. Now it's no longer a round number. Okay, round numbers are more psychological levels. That's where you see a lot of trading actually occur. It attracts a lot of trading, especially at the institutional level, because let's say if a market is trading at 13 rand, okay, we'll feel, okay, the US dollar versus the ZAR, we'll feel at a psychological level that it's very cheap. And if the USD versus the ZAR is at 18 rand, we'll feel that it's overpriced, and it should make its way down towards sort of like fair value, which would be somewhere between 14.80 and 15 bucks, because I'm thinking it's trading somewhere around there even today. Right, so that is obviously the power of the psychological levels. Now, these are basically 50 pip or 50 point increments depending on the market that you're trading. So we're looking at 13 Rand, 13.50. Let's say if you're moving up, so 13 Rand, 13.50, 14 Rand, 14.50, and 15 Rand. Okay, so those are the 50 pip or 50 point increments that we call obviously the round numbers. Okay, hoping that makes sense. Now, candlestick formation. Now, this is probably the most commonly form of analysis within the retail community, and obviously within the professional side, I would say as well, because now a lot of previously just fundamental analysis, let's say firms are really experimenting or adopting a change into the technical aspect side of things. A lot of guys that I personally look up to, who mentioned that they would use just fundamental analysis, let's say back in the 80s, 70s, but obviously they had to adapt probably around the 90s and include some candlestick formations or basic technical analysis to sort of like pair up their fundamental analysis that they also sort of like well equipped with already. So there's a lot of different candlesticks like sort of like formations, and you can try and learn them all. I mean, there's flags, there's it's condescending flag, or I'm not quite sure. Like maybe it's a disrespectful flag, but I think it's descending flag or ascending flag. So there's a lot of candlestick formations that form on the charts, and those tell a different story. So it's very important to be able to sort of like look at the charts and be able to interpret them. So once you're pretty well versed in the art of looking at the candlesticks themselves and candlestick formations rather, okay, because candlestick is just this thing. Okay, let's say this would be a candlestick. All right, and a candlestick formation would be a series of these things that actually tell you something about the market. Okay, so let's just say this would be a pin bar. Okay, let's just imagine that it's a pin bar. Let's just imagine that it's straight. So this would be a pin bar. And then let's say there's another big candle, green one heading upwards, which would tell us that there is a momentum change now heading towards upside. So that would be a candlestick formation, essentially. Right? That would be a candlestick formation. And that tells you a story about what the market actually has done. Right? So it's important to be able to look back at the market and see how these patterns form, and then obviously find out which ones occur the most and what is the probable outcome as soon as that market gives you that type of pattern. Okay. And moving averages, they essentially use average price movement from a certain price period, and they just give you the average price of where the market has been trading. So if you are using the United States dollar versus South African rand example, if the market goes, okay, just as an example, very quick one, market opened at 13 Rand and opened at 14 Rand. So the average price there would probably be, so 13 to 14, average price would be halfway, so that would be 13.50. Okay. Right, so for that particular day, the average price was 13.50, so we move somewhere around there. But what it does, you can input whichever amount of candles that you want the market to move back. So if you say 20 EMA or 20 SMA, okay, that's a simple moving average, a form of moving average. Then with that, you'll be able to sort of like take the past couple of candles, the past 20 candles, and it's going to average the price for those past 20 candles. Okay, So you can have a really good idea when the market breaks above the moving average that, okay, it's actually moving above what the average has been. And then if it moves lower, you'll be like, okay, it's moving lower to what the moving average, the average price actually has been by breaking obviously the moving average. Okay. Now it's just basically a line, a very simple line. You'll be able to insert it from even your MT4, the mobile version of your MT4 platform. You'll be able to insert it there, and yeah, just get it going within a few minutes. In fact, so it's one of the most simpler tools. Like I said, I mean, I don't look for complicated tools to use, because I know the more complex something is, the more the difficult it is to actually execute. Right. So if you have 1,000 rules about entering into a trade, you probably won't have all 1,000 rules in check, and that will lead to frustration, and that will lead to bad trading. You want to have rules that are very simple to follow, very straightforward. Nothing, no gray area type of things. It's either black or it's white. That's it. You know. So the Fibonacci retracement is used to measure pullbacks in a market. So after market has moved in one direction, it's going to pull back, because I'm pretty certain that if you've been in a position that you've feel like you've gotten at a really good entry point, and now it moves up 100 pips. Okay, it moves up 100 pips. Yeah. It's not going to move straight up to your take profit, right? It's going to go down, it's going to go up, it's going to move sideways, it might even go back to your entry again, and then you could still go back up and actually reach your take profit. Obviously, that leads to a lot of frustration for a lot of people, but that's typically how the market moves. Now, old adage, I think I talk about this all the time, old trading adage says that the market moves one step forward, or two steps forward rather, and one step backwards, which means on average you'll see the market pushing up, if it's trending towards upside, pushing up 100 pips and then pulling back 30 pips or 50 pips or 40 pips. So the retracement tool, the Fibonacci retracement tool, is in place for us to be able to measure that retracement, right? So measure what percentage of this move, in fact, okay, what percentage of this move is this one? Okay, so if this one is 100 pips, it moves up 100 pips, and it pulls back, it retraces 50 pips. That is a 50% retracement. Okay, so it moved down 50% of the move towards upside. Okay, it'll become clearer soon if you're not catching every single thing there, but that is the retracement tool, Fibonacci retracement. It's based on percentages, essentially. It's based on percentages, and yeah, with the illustrations that are put into the PDF, you'll be able to sort of like see it a whole lot better. Okay, now we have a chart with candlesticks removed. You only see the price going down on the right hand side. So let me try and zoom in a bit. I feel like this, even I can't see this. My screen is a bit bigger, so I think this should work. Okay, right, so on your right hand side you can see the prices. Okay, here it's 1.18000, 1.7500, 1.17000, 1.650, 1.16, 1.1550. So you can see that increments are 50. Okay, even if you're looking at this as 1,000 or 18,000, this one is 17,050. This one is 17,000. This one is 16,050. That is essentially that increment that we spoke about a bit earlier on the side of the round numbers. Okay, so these are the significant ones that we tend to look for. We tend to look for those particular trading areas because that's where the liquidity is going to lie. Typically, the liquidity is going to be easily observable around these levels. I mean, there could be liquidity at a number just in between there, but I mean, you basically have an indicator that draws a straight line of the entry points where you can actually enter on the trade. Right? I think that makes things so much easier. Okay. Now, as I said, because these levels form a major part of institutional trading, we can therefore safely assume that there's a lot of liquidity around these areas. And I did explain liquidity last week, but it's basically a lot of trading activity, right? A lot of trading activity. So like a busy shop as opposed to an empty shop, right? So a busy pawn shop where they're buying and selling secondhand goods, and one that's not that busy. Stuff is gonna sit on the shelf and wait for someone to buy it, let's say 2 months from now or 3 months from now. But one where people are coming in selling stuff and you're also buying, that that's that's a form of liquidity. Right. There are willing buyers and there are willing sellers. Okay, hope that makes sense. And we're looking for areas like that because that's where buyers will be looking to come in and sort of like drive the market up. Because remember, for the market to go up, someone needs to buy. Right? For the market to go down, there needs to be a huge influx of sellers coming in and saying, all right, this is too overpriced, let's go short. So that pushes the market down. Now, these are great places to trade because there are buy and sell stops around those areas, and price will usually react around those areas. And yeah, especially for day trading, for small amount of pips, usually very fruitful. I won't lie to you. Obviously, if you use the right strategy, so like take 2 or 3 more tools and just combine them with just the round number and some money management, of course, that makes things also so much more um, I can say easier. I can say easier. So just to plot how that round number actually interacts, because remember I took this figure one just without the candles. So just made the candles all white, same as the background, so you don't see them, but they're actually there. And I just draw in this um, illustration, you can say. Now, this is what I spoke about a bit earlier, that the market moves 2 steps forward and then 1 step backwards. 2 steps forward, 1 step backward, 2 steps forward, 1 step backward, 2 steps forward, 1 step backward. So this is 100 pip drop and the market moves back 50 pips and then choose towards the downside. Typically, that's what we like to see. I mean, those are very, very easy to actually, I can say, take advantage of. Right? Those are easy to take advantage of, and you want to be in a position where you can take advantage of these areas because you can easily predict where your entry is going to be. Right? So the day before, 3 or 4 days prior, you've already done your analysis. Let's say on Monday, you already know where your entry is going to be. You're not in a rush, even when it comes to a day trade or a scalp or whatever you want to call it. You still can predict from the previous day where my entry is going to be. If the market doesn't touch that level, then you're not in the trade. That is one of the easiest things you can do to actually keep yourself calm just in trading, basically. Not having to chase the market, just placing a buy limit or a sell limit or buy stop or sell stop and waiting for the market to get into your area. So this is ideally how we'd like to see the markets, right? Trading in between those round numbers. So coming off of 117.50, moving below 117, moving up, okay, pushing all the way down to 116.50 and pulling back up and just sort of like rejecting at 117, pushing all the way down to 116 and then pushing up just above 116.50 and then pushes down to 115.50 and back up to 11600 before dropping towards the downside. Now that's ideal. That's what we want to see in sort of like a perfect world. But obviously, as we all know, the world is not perfect. And I think trading is one of the most imperfect things you can ever come across. But you look for days where the market behaves the way that you want it to look. It doesn't work the way that you want it to work, then you don't trade it. So yeah, figure two basically shows how price will typically move in a perfect world, as I was saying, around those round numbers. Using the first swing as an example, the market broke below 11700. So I already explained all of that. And here we head on to the next figure. Okay. All right. So I think this was supposed to be figure 3. I'm only just noticing this now. So we just put the candlesticks back on now. Right, remember previous screenshot didn't have the candlesticks, and then I just changed the color of the candlesticks so they actually popped up. This is still the same exact chart. Just that I think it's just the candlesticks that are a bit different. Okay. So we have that swing again, boom, down to 117.50, push up, and then pull all the way down to 11700. See the market comes up again, just misses 117.50, but comes back to touch that level, and then moves down and touches. I think this is 116.50, and then pushes up, and then pulls all the way down, just breaks below. I think it near touches 11600, and then pulls all the way back up until like closes to end of sort of like the week. I'm not sure if this was a 4-hour chart or a 1-hour chart. Yeah, I think this was 1-hour chart. Yeah. Okay, and then it basically ends off sort of like that week, because there's a double vertical dotted lines that indicates the end of the week, right? Now look at where the actual sell stop will go. So that would be in the next figure, because obviously it's one thing to be able to see where the market is heading, and it's another thing to actually know where to enter into the market and where to exit from the market. So those are two different things that you also need to be able to do competently enough, so you'll be able to generate some decent profit from the market. And yeah, we look at where the actual sell stop will go. An example, it's let's say at 11700. Okay, so this is a sell limit, which is at the safest place that we like to see the market coming into, right? So we want it to be outside the range of 117, the stop loss, which is obviously stop loss here. So at 117.50, it's just outside this swing high, and it's also just outside that round number. Okay, and our pending order, our sell pending order, which is basically going to, in this scenario, going to be a sell limit, is at 11700. So it's at 11700, and if we get the market pulling back up, we already know that if it touches 11700, then we're in a trade. If it doesn't, then we're not in a trade. Okay. And if it does come in and touch it and then continues to head upwards, then it's going to take us out with the stop loss. So with the minor loss at 117.50. Okay. You guys are all on the same page. Okay. Now, I'll give guys who have questions opportunity to ask them while I go through just some basic stuff that obviously I wanted to go through from the previous session that we were supposed to have, which is on Tuesday. Okay. Now, candlestick patterns will conclude obviously next week, because I just like taking things sort of like segment by segment. It just helps to make more sense instead of just throwing everything out there. As I promised, tomorrow I'll send through sort of like a small questionnaire or piece of work that you can actually get done over the weekend just to help you practice on your MT4 regarding like the round numbers and how to essentially use them, how to place your sell stop, how to place your buy limits, all of those things that do make up obviously a very profitable trader in the end. So as I said, this particular month we'll be doing one-on-one sessions. So I think from September, September that we're going into, September. Wow. So I will be doing one-on-one sessions. So if you do have any questions regarding that, you can just follow the link to our WhatsApp in the Telegram channel. So if you missed any parts of the session, it is being recorded. I will make sure that everyone gets a copy of the recording so you can just watch over it. And if you're still a bit confused, just go on over to the beginning, right? Re-watch it, take some notes, and if you have any questions, obviously make sure you just shoot them through, right? I'll be available for you guys to ask any questions that you might have. So if you don't have any questions now, I don't see any questions, I'll be ending off tonight's session here. And I will continue with the beginners tomorrow, 9 p.m., same time, right? 9 p.m. for the beginner session. So make sure if that's where you belong, you make yourself available for that. Aside from that, guys, enjoy the rest of the evening. Cheers.